Well, today we are seeing a sell-off in the bond market, and of course that has been exacerbating declines that we saw south of the border and on the TSX when it comes to equities. The catalyst today seems to be job opening numbers that showed job openings increasing from the previous pace, the first increase that we've seen in about 4 months. For some perspective on where the selling pressure in the bond market might end, let's bring in Andrew Brenner. He's the head of international fixed income at Natalliance Securities. Andy, always great to speak with you. What do you make of what's going on? Does it make sense as every single Fed member comes out and really beats us over the head with this higher for longer mantra?
Well, the higher for longer is certainly the mantra that has got the market's attention. As far as the JOLTS number that you referred to, I don't really think that that's the catalyst today. The market was already on its way down at around 6:30 this morning. It had a relief reverse. And then I think the big catalyst is when the Bank of Japan had to come in and stabilize their currency as it got above 150 versus the yen. And that just sent the long end of the Treasury market into free fall. Last I looked, the long bond was up in yield 11 basis points. And as we said in our morning commentary, once it breaks this 485 level, we're looking at a 5% type handle, and we're not very far away. Basically, the bond vigilantes have the Treasury market where they want it. There's no fiscal discipline in Washington, and they're just going to continue to pound on the market until something breaks. As I look from 3 years out to 30 years, they're all at roughly 2006 to 2008 high yields, even the long bond, not so much the 2-year, which is why we've been liking the steepening trade, and that's been very successful for us. We're now stepping away from that because we reached our objective. But as far as today goes, you know, the government deficits are out of control. The bond vigilantes, which is a term that Ed Yardeni coined back in the Clinton years, they're back, and the Fed is not there to support it, and other central banks are not there, and real money's stepping away. Even today, we saw 5 new deals get canceled because the bond market is just too volatile. I'll stop there and let you ask.
I would love to unpack that, because where do the bond vigilantes go from here? We saw a very effective, I guess you can call it that, a play out in the UK with Liz Truss. Do you expect those kind of consequences, or is it going to take a while before, you know, the ears in Washington start to perk up to what's going on in the bond market?
I think the ears in Washington are tone deaf, and I think it's going to take a long time for them to perk up. But the reality is there. I think something will break, which will force the Fed to change their higher for longer mantra. But for now, I can see 10 years getting to 5%. I can see long bonds maybe getting to 5.20, maybe even 5 years close to 5% as well. And I'm a bond bull. You know, I mean, Bob Michel over at JP Morgan said a few months ago he expected the whole yield curve to be flat, but he was thinking it from 3% 2 years to 3% long bonds. And he may still be right, but not this year. It looks to me like it's going to be 5% flat from 2 years to long bonds. So that's kind of where we stand, and that's kind of what it looks like. As far as the vigilantes,
wouldn't you say we're close then? I mean, it seems like what you're saying is the worst of the selling pressure is behind us.
I think it is, but it doesn't seem like we've had capitulation yet. The way that we're trading today, I thought last week we had capitulation when you got up to 474 and on 5 years, and you got to 468 on 10 years, but that obviously is not the case, and we're now at higher levels. I'm seeing massive selling of futures, which tells me these are hedge funds, which are basically my term for the vigilantes, and they're continuing to push. They will be forced to cover something. Maybe the employment number on Friday will be the catalyst, and it will reverse quickly. But it looks like you're gonna get very close to 5% first.
You look at you're worried about things breaking, and I'm wondering where that might show up. Obviously, we talked about the regional banking issue in March, so the Fed did a good job at ring fencing that without altering the course of rates. When you look at high yield, the high yield ETF trading at the lowest level since November 2022, is that an area?
I mean, I have to break that down. High yield is not the high yield of old. It's a much higher quality high yield. So I'm not paying too much attention there. As far as breaking, I think the stock market is breaking. What you're seeing is you no longer see a correlation between stocks and bonds. Bonds go up in yields, stocks go down in price, and then stocks continue to go down in price, and we're not really seeing a rebound in bonds, unless you want to call it the steepening of the curve, a flight to quality trade. So I think it's more equities, and I also still think the banking system is in trouble. I think banks have massive losses in their hold-to-maturities. I think they're having trouble with deposits. They're having to go up to over 5%. It's going to hurt their earnings. I don't think there's anything positive coming out of this, but I think it is going to turn quickly, and when it does, I mean, basically, we've had 140, maybe 150 basis point higher in 10 years in the last few months. That's unheard of. There really hasn't been anything going on. And the Fed is done. I don't care what Bowman says or what Mester says. There's not going to be any more rate increases because real rates are so high. 10-year real rates, when I stepped into this conference room, were at 242. We haven't seen that in 15 or 20 years.
And so with that kind of as the point, and I want to pick up on what you said about the banks. The banks are sort of in a bind here in this environment. That might slow the economy. We've seen this explosion, though, in private credit to kind of pick up the slack where they are. Do you expect that to continue? Does that concern you when it comes to things like financial stability?
It absolutely concerns me. There's no question about that. As far as private credit goes, we've talked with a lot of private credit people, and they seem to be some of the smarter people around with good analysts and whatever. So I think they're okay for now. There's, the number is somewhere around $2 trillion, but I don't think that's going to bail things out. And we've continued to see widening of spreads. In CUSIP business, we see IG spreads have gone out from about 62 to 75, and high yield spreads, which again is not the high yield of old, have gone from about 408 to roughly 496 when I looked at it this morning. I think they'll probably peak at around 515 based on the charts. So there are a lot of things, but I think banks are just going to have trouble doing their normal business. Their deposits are going to cost them a lot of money. No question about it, because everyone can so easily go move into the Treasury market yielding 550, 560. I think that's the smart thing to do.
I want to end where we started about the yen and the yen surging, reaching the weakest level, I should say, versus the dollar since October 2022. That tends to create a lot of problems in hedge fund land for people who are using things like carry trade. How do you see that flushing out?
Well, remember, the carry trade is you're short the yen. So as the yen goes down in price, that actually helps the carry trade. But what it does, it scares off Japanese buyers. And Japanese buyers historically are the long-term buyers, in other words, the 30-year buyers. Now, I looked at a report put out today, I believe by Goldman, that said that the spreads between 30-year treasuries and 30-year Japanese debt is some of the widest that it's been in a long time. So I think once we see some stability, we'll see a lot of buying out of Japan. But for now, that particular part is not going to hurt the carry trade. But if the Bank of Japan starts to raise rates even higher than they are to support the yen, then we have a problem.
You still like your 6-month T-bills?
I like 6-month T-bills, and to be honest, I'm glad you remember that. To be honest, I'm actually moving out to 18 months to 2 years. That's where I've been buying because I think at one point this will turn around, and I don't want to be, have to reinvest T-bills at 4.5%. So I'm putting stuff out all the way out to 2 years now.